Is that better? Can you hear me now? I have just found something that I hope is the right thing, and it looks like something is working. Can you now hear me? Oh, there we go. I see a few hearts, so now we should be back up. Okay. I am not very IT skilled, and I promise you this was the fastest I've ever managed to sort out something IT-wise. Okay, Lapierre, thanks. Seems like I'm working. Okay, let's see. MP4 says, can I ask you something? If you retire and after tax and everything you get $1 million, how do you invest it? MP4, people very often ask this very same question, and I always have the same answer. And the answer is, I can't tell you how to invest the money. And the reason why I cannot tell you how to invest the money is if I don't understand what your needs are, I can't give you an answer. If I don't know whether you need to go and get capital growth on your investment, whether you need money for emergency funds, whether you need an additional income, whether you need to settle debt, because folks don't understand, but to a certain extent, settling debt is sometimes an investment. So if I don't know what your situation is, I cannot really advise you because I don't know what you need. That's the first thing. The second thing is every person, every individual has a different risk appetite, as we call it. So some people are very aggressive. They like to take some chances in life, and therefore they are willing to make use of investments and portfolios that are pretty aggressive. So you might be a person like that, or you might be a person that is very safe. You're very conservative. You don't want to take any chances. You want to ensure that your money grows, even if it's just a little bit, but there's never any loss. There's never any up and downs, like the market go up and down. Or you medium risk investment, you're like in between this guarantee type person and this very aggressive type person. So I can't really answer you unless I've had a consultation with you. I can only answer anybody and give them a truthful answer with regards to what they can do with their 1/3 money once I understand their personal circumstances. I've just mentioned a couple of things now: the type of product, the type of portfolio, and the risk. I haven't even touched on things such as your financial dependence. If you have financial dependence, then we have to figure out whether this money should be available for them in the event that you should pass away. So MP4, there's a lot of questions I need to ask you as a financial advisor before I can make any recommendations and give you any advice. So I'm going to do what I always do, and I'm going to say to you, contact me on the WhatsApp number in my profile or via my website, and we can set up an appointment. I can do a consultation session with you, or one of my advisors can do such a consultation session. And then we can give you an answer. We can try and give you feedback and give you recommendations. Okay. Okay. It seems like everybody can hear me now. Tune your volume. If I have 65,000 for 1/3, if I have 65,000 as my 1/3. Okay, so PG, if you're asking if you have 65,000 as your 1/3, how much tax will be taken on? So on 65,000 Rand, if you have not taken any 1/3 pensions at any stage previously in life, then the full 65,000 Rand will be tax free. It's only if you have actually taken a 1/3 from a pension fund, provident fund, or retirement annuity, and the amount that you have taken was more than 550,000 Rand. If you've done that in the past, then your 65,000 Rand will be taxable, but then it can be taxed anything from 18% up to 36%, depending on how much that 1/3 was that you took in the past. So let's say you literally just took 550,000 Rand, and now this is another 65,000 Rand from a retirement annuity, tax will be 18%. Okay, and so it will go. So there's a whole formula, but I think if you are asking, now this thing says I must lower my speaker volume. I just can't seem to win tonight. So basically at the end of the day, it's all going to depend on what you have taken or have not taken. But if I understand you correctly, and this is this first 65,000 that you're ever taking, it's going to be tax free. Okay. Thank you, Graham G. Appreciate it. Seems like I'm good now. Although TikTok is now saying to me that my volume is too loud. I'm not coming across clear. So if I'm not coming across clear, tell me. I'll try and adjust again. MP says, I want to generate an income on the million. Okay, so MP, let's take it one step further. You want to generate an income on that 1 million rand. So now the next question now that starts coming in. This income that you want to generate, does this income have to be guaranteed for a specific period of time? 5 years, 10 years, 15 years, the rest of your life? Do you want to leave money behind for financial dependence? Because that's going to have an influence. Do you want the premium to escalate on the income to escalate on a yearly basis, because that's going to have an influence? So that 1 million rand that you want an income from, you can now have either a guaranteed income plan where there is certain things such as the time period that you guarantee it for, the income increase that you guarantee it for, whether it's a single life or joint life and survivorship that you can guarantee it for. So there's several guarantees that you can build into such a plan, and you can invest the money like that. Or alternatively, if you say, no, I want the money in the same form as a, I want to invest the money in the same form as a living annuity would have been, where I take a percentage, and I'm going to try and take a percentage that's lower than the growth to ensure that my capital remains. Then you have to go into something like a living annuity type product, and in this case it will be actually a unit trust. So once again, it's going to be a choice of what is needed from your income. As a matter of fact, depending on how much the income is, one might even go and do a combination of products for you and say, I'm going to take a portion of that, I'm going to give you the income that you need. I'm going to take the other portion, I'm going to build a capital growth plan for you. And this is more in relation to the tax that you're going to have to pay, because the tax will have an influence. And if you are going to fall in a higher tax bracket, then endowment might be better than unit trust. So then you will do a combination of products. So MP4, as you can see, there is a variety of factors that needs to be taken into consideration. And I hear what you're saying to avoid SASSA, which says to me, this is the only million rand that you have, and that you don't have anything more than that. Well, then it's once again going to come down to that planning session. I mean, we've now spent a few minutes on a number of questions that I've asked, and a number of things that I've positioned. But there is, we've basically scratched the surface with regards to the information that I want or need before I will be able to give you a proper recommendation. Okay. Sorry. Rui, hi, how much interest must I earn per month to pay tax? Oh, sorry about that. And this bottle needs to be thrown away. So how much interest must I earn to pay tax? So basically, if you earn more than 23,800 rand in interest per year, then you're going to pay tax. So that basically comes down to 2,000 rand per income per month. 2,000 times 12 gives you 24,000 rand. So if you earn 24,000 rand in interest, then 23,800 rand is still going to be tax free, and 200 rand, I had to think there for a second, 200 rand will be taxable. Now obviously, if this is all you earn, if you only earn 24,000 rand for the year, and therefore only 200 rand is taxable, then you're not going to pay tax. So whether you will pay tax on that 200 rand or any amount over the 23,800 in interest is all going to depend on any other incomes that you have. Because Interest is taxed at income tax rates. So the receiver says, okay, whatever you earn more than 23,800 Rand, we see that as income that you receive. So if you are earning, let's say 240,000 Rand income per year, 20,000 Rand per month, and you are being taxed on 240,000 Rand, which I think is 18%. But you earn interest, and let's say you earn 160,000 Rand interest. So basically 130,000 Rand of that is going to be taxable. They add that 150,000 to your 240,000. They say now you earn 370,000 Rand in income, and now we tax you on that, and you move into a higher tax rate. So that is basically how it works from that perspective. Okay. Hiroshini, many people don't know about Section 37C of the Pension Fund Act. Planners don't advise clients about it. Very important in estate planning. Was there anyone held responsible for reason to? Hang on a second. Let me just see something here. Let me just see something. Sorry, I'm just checking something while I'm talking to you, which is relevant to the statement that has just been made. Okay, so Section 37C of the Pension Fund Act, I just want to read it to you. Exclusion from deceased estate. Death benefits do not form part of the deceased estate, member's estate, and are not distributed according to a will or the interstate succession. That is correct. And what you are talking about here is a almost a technicality. What you're talking about here is a technical thing. And yes, I suppose nobody talks about it, but it's because it only becomes really relevant when it comes to estate planning. It's not really relevant. That section that you just talked about, Hiroshini, is not really relevant when you are discussing with a client their post-retirement income and their income needs, okay? But it becomes relevant when it comes to estate planning. But I think the important thing to know about it is that because it's excluded for your estate, it's actually a good thing. That's the good thing about it. So any pension fund, provident fund, or retirement annuity, living annuity is going to be excluded for your estate, which is good for your estate from a cost perspective and a tax perspective. So you are correct with what you're saying, but once again, it's something technical that very seldom comes up unless we are in that in-depth planning session. Okay. Bob Spanish here. Was there anyone held responsible for the recent 20 billion loss on GPF investments portfolio? Bob, I cannot tell you, my mate. I've said this in a video the other day. People are so concerned about the GPF and the losses, and I know it's not something that we should just gloss over and say, listen, yeah, these oaks are losing money hand out over fist. But the thing that I can tell you with regards to the losses of the GPF, there is a lot of cases that's being investigated. There's a lot of people that has been found guilty of fraud and corruption. There's a lot of people that is paying the price for that with either jail terms, etc. And I personally am not going to try and investigate every GPF loss that comes across the board. The fact of the matter is that the GPF, even with the losses that's been there, is such a strong fund that even if they never get this 20 billion Rand back, the fund is so strong, even if they never get it back, that the GPF will still be able to, what do they call it, to honor its guarantees, to honor its income and everything. So when it comes to pension funds and stuff like that, they always have to have a reserve fund. That's part of legislation that says, listen, you have to have X percentage of the fund always available over and above what the fund value is, so that if money gets lost, you can still, you can still honor your payments. So with the GEPF being worth billions, they must have a liquidity guarantee that is in line with Pension Fund Act. And I'm not sure I'm not sure if it's 15% or 20%, but I know it's reasonable. So in terms of 20 billion, it's a sizable loss, but it's not close to what they need to keep in any case as a guarantee over and above. So what this guarantee basically means is that the guarantee says, if everybody has to resign today, everybody resigns or retires today, and you, GEPF, have to pay out everybody, all their incomes, all their resignation fees, everything. You have to pay everything, you have to do it today. Then the GEPF must have enough funds to do that and to pay over and above that another, and like I said, I'm not sure what the figure is, but 20%. They must, after they've paid everything, there must still be 20% left in the fund. That is effectively what it comes down to. So Bob, that's why I say, with regards to GEPF, I know that there's been losses. I know there's been fraud and corruption. I know all these things. But for me, in my world, and the clients that I work with, 20 billion is not going to affect them, or their income, or their pension. And to be honest with you, the GEPF is not the only fund that has taken losses due to things like fraud and corruption. There are many funds that that's happening to. Do you know how many funds there are in South Africa? Pension funds and provident funds from private companies, where the private companies have not been paying over the contributions of the employees to these pension and provident funds for not 1 month or 2 months, for years. If all these private companies are going to be sued and they have to pay compensation, whatever, I promise you it's going to be much, much worse and much, much more than what the GEPF's losses are. So there is my piece about the GEPF. I hope we never have to worry and talk about it again. It is and still remains one of the biggest and strongest funds in South Africa and in the world. Okay, what's the difference between IRP3 and IRP5? Now you're really challenging me, because I'm not a tax consultant, okay? I'm really not a tax consultant. But as far as I know, is the one thing, the IRP3 or the IRP5, I'm not sure. One of them is a tax directive that's issued by SARS, or that's issued to SARS, not by SARS, to SARS, on your income. To say, listen here, this guy is earning X amount of income per year. Okay? So, and the other one, I believe, is a tax certificate that is issued on retirement annuities to say your contributions for the year was this. So don't ask me which one is what, but that is as far as I know. I see my good friend Graham G was on here now. He's an accountant, and he will most probably be able to pop into the chat what an IRP3 and an IRP5 is. Excuse me. But it's tax certificates that's presented to SARS to tell SARS how much your income is that you've earned for the year. And I think the other one is to tell SARS how much you've contributed towards your retirement annuity for the year. So that those two documents basically tell SARS then what your figures look like, so that when you do your tax returns, that they don't say, well, we don't really know how much you're earning, and you've just told us you earn 240,000 Rand. We don't know if we can believe you. So that IRP basically says to SARS, you can believe this person, that is what they're earning. Okay, I hope it's answered you, even if it's a little bit MP4. Rui says, hi, I'm a pensioner. I have money in the bank. Do I still have to do my SARS asking for a friend? Rui, yes you do. It doesn't matter whether you are employed, whether you're a pensioner, doesn't matter. In South Africa, if you earn an income, irrespective of your age, you must declare it in order to do tax returns. As a matter of fact, you can, as a parent, get a tax number for your child when they are born. When they are 1 year old, you can apply for a tax number from SARS already, so that things such as retirement annuity contributions can be sent into SARS against your child's tax number to get the rebates. But yes, at the end of the day, it doesn't matter whether you are employed, on pension, whatever, you have to do annual tax returns. If you have money in the bank, Rui, and let's assume that this money is giving you an interest that is small enough for you not to be taxed, okay? If you earn an income that's small enough for you not to be taxed, you still have to do a tax return, but I think they call it the zero return, and you then don't have to pay tax. But you still have to tell SARS what you're earning and what you're not earning. Okay. I hope that answers it for you. Rosette Music says, why do they have to do that today? I don't know what you are referring to. I don't know what you're talking about, what they must do. There we go. Graham, thank you. I knew you were going to pop in. Graham says, IRP5 is your certificate for your earnings and PAYE. There you go. Eroshini Baldov, please go over how to read performance of funds reflected on their graphs, Allan Gray Balance Fund, for example. Okay, so how to read the funds on the graphs. Okay, so the very simple thing, and that is what most people look at, is when you open a fund fact sheet, they normally have a section where they tell you the 1 year return, the 3 year return, the 5 year return, and 10 year return. And then they've got from start return. So what that thing basically tells you, it says to you, okay, we are now in the month of July 2026. So the latest fund fact sheets that companies would have put out there would have been those until the end of June. So that fund fact sheet will now tell you, from the end of June 2025 until the end of June 2026, the 1 year return on this fund was, let's say, 10%. Okay? So that is exactly from June last year until June this year. Then there will be the three year one that says the return over the last 3 years were 9.8%. Now that return won't be 9.8% per year. What it would be is the average return over the last 3 years. So you could have had 10% 1 year, you could have had 8% the other year, and you could have had 9 point something percent the other year, and those added together and divided between 3 years gives you an average return of 9.8% per year for the 3 years. And so it will be the same for the 5 year and the same for the 10 year. So you can go and see what the average returns is. So here's the little thing that people battle with, is if you go and read that fund fact sheet for the month of June, okay? And then you go and read the different one, let's say for the month of March, you might have quite big differences depending on the time period. And the reason why I say you might have big differences depending on the time period, if you were invested in the market in March of 2020 when we had COVID, and you look at the 5 year return from March 2020 until March 2025, you will most probably see a big return on investment. Why? Because in February of 2020, the markets took a nosedive and was very, very low at March. But then it started recovering very quickly, and since then the markets are still recovered. So you will see that the 5 year average for that fund is very, very good, for argument's sake. When you go and you look at the June 2020 return to June 2020 this year, the figures won't be so impressive, because by June of 2020 the markets had recovered substantially. So the market was much higher than what it was in March of 2020. And although the market has kept on growing for the 5 years, it has not gone up that high from June to June than what it had from March to March. I hope that makes sense. So basically, that is what people normally look at to get a good idea of the performance of a fund. And it's a very good indication on whether a fund is good or not. But that is what most people use, and they look at nothing else. At the end of the day, what is important is to also go and have a look at, it's normally in the top left hand corner of the fund fact sheet. It shows you there, either with numbers or with colors or whatever, whether this is a conservative fund, a low risk fund, a medium risk fund, a medium aggressive, or a very aggressive fund. That gives you a very good indication of how much shares there is in a fund versus bonds, cash, and properties. And then one of the very important things is the objective of the fund. You have to go and read the objective to see what is it that the fund manager, the portfolio manager, is trying to get right with that fund. And normally it will tell you in there, the fund manager wants to get growth over a long period of time, 5 to 7 years or longer. And if the money is invested for that period of time, 5 to 7 years or longer, he is trying to beat inflation, let's say by 5%. So there it tells you as the investor if that fund is ideal for you. Because if you're an investor that only wants to invest your money for 3 years, and you want your money to be as safe as possible, you just want to beat inflation by 1 or 2%, then that fund is not going to be ideal for you, because the objective is long-term high returns, and it is most probably a medium to medium aggressive or even aggressive fund. And what you're looking for as an investor is something more conservative, because you want something over the shorter term. So those three things I think is sufficient for you as a client to go and look at. You go and look at the risk spectrum, the objective, and then the returns over the 1, 3, 5 and 10 year periods. And that should give you a very good indication of this fund. There's a lot of other information that's also on these fund fact sheets. Okay, there's really a lot of other information that's also on these fund fact sheets, but I don't think that most people find value out of that. I think that that's more of value to the portfolio managers that really likes to get into the nitty-gritty of funds and how they're structured and so on. And then, yes, there is the cost. The EIC is on there for that specific fund, so you can go and see that. But let me not get into cost, because I really do not see cost as such a big problem as most people. And I think I've elaborated on that quite a bit. Any case, I hope that answers it for you, Hiroshini. I hope that gives you a good idea. So Allan Gray Balance Fund is going to be one of those medium risk funds, okay? SARS normally does the tax automatically, and if it's done like that, so do I have to go and do it at SARS? Rui, my friend Graham, if you want to, you can give this guy your cell phone number. I won't do it. But Rui, you're most probably going to have to speak to somebody to get a bit more information on this. I am not a specialist on tax returns. I know that you can do your own tax returns these days via e-filing. I know a lot of people do it, and I know that most of the time the tax returns are pretty straightforward and correct, especially if there's nothing funny with regards to tax returns. But I know when it comes to doing tax returns, and you've got things such as retirement annuities that SARS don't know about, additional incomes that SARS don't know about, medical expenses, a business, rental incomes. There's a lot of factors that could actually influence a tax return. And that's when I would say go and speak to a tax specialist, a tax consultant can help you do tax returns. If it's a straightforward, simple a tax return because you earn income and your taxes are being deducted by your company via the PAYE scales and stuff like that, it's not going to be very complicated, and basically any accountant can assist you with that. But yeah, I'm not going to try and answer any more about the tax. I think I'm already out of my depth with the bit that I have mentioned to you. Mario says, hope you are well. Thank you very much, Mario. I am indeed, sir. Hi, SpongeBob. Good evening to you. Iroshini, how many funds should your RA be invested in and what split? Now, that is a very interesting question. Because I personally don't think that one should have a lot of different portfolios. I sat with a client a few months ago and we looked at his investment portfolios, okay? And in his portfolio, in his investment, he had no less than 26 funds. Now, that's a hell of a lot. So what's the problem with this? We normally say that it's over diversification. So with the fact that he's got 26 funds, okay, it is spread across from very conservative to very aggressive. And when we went and we evaluated this and we went and we put it on the pie chart, we came to the realization that it was basically a medium portfolio that he has. Over and above that, when we looked at these 26 funds and we looked at where they were invested in, the South African funds that he had, 80% of the companies that they were invested in were overlapping and were appearing in the various funds. Similar with his international stuff. So you've got all these 26 different funds and it looks very impressive because you've got this big spread of portfolios and it's complicated and everything. But at the end of the day, there's so many things that overlaps. You've got 10 medium risk funds and all of them are invested in Naspers and Anglo Gold and British American Tobacco. It just doesn't make sense. At the end of the day, it just doesn't make sense. So my honest opinion is, you can get away with 2-3 funds in just about any investment. Yes, if you want to I suppose impress a client or bamboozle a client, then it's fantastic to put all these portfolios together and to tell the client how you're diversifying it. But at the end of the day, I think it is a load of hogwash. I really think that most people have to be invested in 1, 2 or 3 portfolios. They really don't have to be invested more. If they've got more than one investment, hey, maybe make use of 2 or 3 portfolios per investment and do a bit of a split and diversification that way. So that's the first thing I want to tell you, is that I think that most people are overly diversified or wants to be overly diversified because I want 5 cents in every one of these companies or portfolios. And at the end of the day, may I say you're bullshitting yourself? But that's basically what you're doing. Or the advisor is BSing you. When it comes to a retirement annuity, because the legislation with regards to retirement annuity says that it must be Regulation 28 compliant. Okay. It is my honest opinion that there are a number of portfolios out there that are built to be in line with Regulation 28. So what does Regulation 28 say? Regulation 28 says you can only have a maximum of 75% shares in this portfolio, of which 45% can be global shares. The other 25% of the fund must be split up between cash, bonds and property. Okay? Now, if you've got a portfolio that is structured like that, it's already doing the best it can, so to speak, to get the best possible growth because it's as aggressive as you can have it. Now, if you do not want to make use of a fund that's specifically geared like this, and there's a number of them that does very well, you don't have to wonder too much about it. Then, if you don't want to make use of one of those funds or that fund alone, then I would say 2 to 3 funds, portfolios, unit trust, call it what you want, in the investment is more than sufficient. I really think, and I really hope that people will start simplifying their own life when it comes to investments. I know investments can become very complicated, but you really do not have to go and reinvent the wheel and try and be too smart. It's like somebody that goes to have their car serviced and the mechanic says, listen, we're going to have to replace your brakes. That's all that's needed, a oil change and a brake replacement. But if you think that there's more wrong than that, then the mechanic can start going, okay, well, we have to do this and this and this, we have to replace your cam belt, and the mechanic can basically do 10 things that's not necessary. And all it's going to happen at the end of the day, it's going to cost you 10 times more, because you are concerned that just replacing the oil and the brakes is not sufficient. So what I'm trying to get across, and I hope I'm getting it across, maybe I'm just waffling here, is keep it simple. 2 or 3 portfolios. You really do not have to go and become too complicated with it. You see, I don't know why, but tonight seems to be on the slow side. I see we're up to about 32 people that's listening now, but normally we're up to about 50 or 60 now. And I see there's very few questions coming in. So, Bob, I hope this is the last, or I hope this is not the last question. It's the last question at the moment in the chat, but I hope more questions comes in. So, Bob asks, how does my RA fit alongside my employer pension and tax-free savings account? Which one would be priority? So Bob, here's the thing with regards to retirement annuities. Okay, retirement annuities, taking out additional retirement annuities is for 2 reasons and 2 reasons only. You want to improve your retirement capital, number 1, and number 2, you want to get the benefit of the tax rebate that you get on the premiums. Okay, so the wonderful thing about that is retirement annuities, like your pension fund, is a forced saving mechanism that helps you to discipline yourself to make sure that you've got enough at the day of retirement. The one thing that people don't always remember about retirement annuities is that over and above the premiums that you contribute, that you can deduct from tax, the growth that you get inside of your retirement annuity is tax-free. So your tax-free investment and the growth you get in your tax-free investment is tax-free. Your retirement annuity and the growth you get inside of your retirement annuity is tax-free. So from a tax perspective, both of those products are ideal to take in association with your pension fund, especially if the intention is that you want to contribute to these types of investments to have a better retirement somewhere in the future. The only thing that I would say is that the tax-free investment, because it's limited to 46,000 Rand per year, it's limited to 3,833 Rand, and it is one of the investments that I believe that people should be invested in for a long period of time, not 5 or 10 years. I'm talking 20, 30, 40 years. If you really want to see the power of a tax-free investment, that's how long you have to be invested in. A long time period. The retirement annuity, obviously also a long period of time, but the retirement annuity is more geared, like I say, not at getting just the benefit of the tax return at the end of the day, but to make that provision for the future. And here's another thing, and this is where it becomes really a bit technical and a bit difficult to explain or to determine, is once you start building wealth, then at some point you want to say, okay, well, I don't want everything in retirement annuities and pension funds, because one day when I start getting my income, all of the income is going to be taxable, and I want to ensure that I get a good income one day, but I don't kill myself with taxes. Then you have to start thinking about the tax-free investment and the fact that it can give you tax-free income one day, endowments, because they can give you after-tax income, and combinations of these will put you in a lower tax bracket. So then the planning really becomes fun. I therefore do not think that the tax-free investment and the retirement annuity should be in competition with each other. I think that you as an individual must understand that your two investments, although they're both very tax efficient investments, have different or mostly different end results. So mostly different outlooks for the future in terms of what you want to accomplish with them. I think that both of these investments, the question should be, what do I want from this investment? Do I want to get an income from it in the future? Do I want liquidity now? Things like that. And I think that will give the better answer. Again, tax-free investment, 46,000 per year. So if you have to contribute, let's call it 72,000 Rand per month to these type of investments, you're going to have to split it in any case, because you will put 3,000, you will be investing 6,000 Rand per month, of which 3,833 will go to the tax-free plan, and then you have to take the difference and put it into something else, be that an RA, endowment, etc. So Bob, I don't know if I've now elaborated too much, or I hope I've answered your questions, what I'm trying to say. It's Rihanna says, what is the difference between the RA and the unit trust? So Rihanna, a retirement annuity, okay, is an investment that you contribute towards retirement, and all the contributions you put into a retirement annuity are tax deductible. And when you get to retirement, you can take 1/3 in cash and 2/3 as a monthly income. A unit trust is where you put money in, where you invest money on a monthly basis, and you can withdraw the money at any stage as you please. On a retirement annuity, on a unit trust, pardon me, the capital growth on that unit trust could be taxed when you make the withdrawal, depending on how much that capital growth was. So with a retirement annuity, you get tax rebates on the premiums. At retirement, you get certain portions of the 1/3 tax-free, and then the income is taxable. On the unit trust, you invest the money, you get capital growth, and depending on how much that capital growth is, you could potentially pay capital gains tax. And here's the interesting thing. Unit trust can be taken as a loose standing product, but you can also choose to have a unit trust fund inside of your retirement annuity. So the same unit trust portfolio or fund that you want to go and invest money in, to have it available, to have it liquid, and that could potentially have a CGT implication somewhere in the future when you withdraw the money, that same unit trust you can use within your actual retirement annuity. So you take out the retirement annuity and you say, okay, the unit trust that I want to invest in is the company ABC unit trust. I can either do it directly in this unit trust and withdraw the money as I please, or I can take company ABC unit trust, put it within my retirement annuity, get the growth similar to what I would have gotten when it was a standalone, but now I can't draw the money until I get to retirement, and then only can I take the money. So in essence, that's the difference. The tax implications and how liquid, how available the funds are to you as the investor, when you can take it, when you can't take it. Bob, thank you very much. Thank you very much for the question, and thank you for saying thank you very much. It lets me feel that at least I've answered it. Iroshni, if your RA is payable at age 55, at what intervals can you extend, and what are all the benefits? So Iroshni, with regards to a retirement annuity, if the maturity date that you have taken it out on is the age of 55, you can actually extend it for as long as you want. Once you get to the age of 55, with some companies you have to actually inform them and extend it on a year-to-year basis, or you can choose a longer term. With other companies, you don't even have to inform them. You can just keep on going with the retirement annuity. The other thing is, once you get to that age, you have the choice whether you want to still contribute towards a retirement annuity, so still keep on paying premiums to retirement annuity, or whether you just want to let whatever you've invested in at that stage lie there and keep on growing without any further contributions. So it's literally up to you as the individual whether you take the money, leave the money, keep on contributing, paying premiums, not pay premiums. It's really all up to you. And then where in the past we had a limit where they said by the age of 70 you have to take your retirement annuity, you have to exercise an option, that rule has fallen away, and now you don't have to ever take your retirement annuity. You can pay it until you're 200 years old, and then if you pass away at the age of 200 and you've beneficiated your children or whatever, they can inherit it, and then they can exercise an income option. So that's basically what happens with retirement annuity. You are not limited in any way or form with regards to the maturity date as to whether you have to let it pay out to you. You can keep on paying it. Okay. It's Rihanna says, thank you, it makes more sense. Great, I'm glad to hear it. Roshni says, thank you. Folks, it is 6 minutes to 7 and there is no more questions. So while there is no more questions and there's a bit of time left, I feel that I can tell you something that's interesting. I've been talking to a gentleman that's contacted me based on one of my videos, and he was interested in getting some financial advice with regards to his own investments. And he was asking me about my consultation fee and stuff like that. And when I told him, he said, okay, thank you very much. I'm not interested. I've done all these investments myself and I've made use of AI. And he said that the fees that financial advisors charge are just too big. So I smiled, I laughed, I replied to him, and I said to him, well, I'm glad, but the fees is not necessarily always the biggest problem. Then he said to me, okay, what would you have done? And and I gave him a very basic outline, and then he fed it into AI. Because one of the questions he asked me is, what do I think of bonds? And I do not particularly like bonds. So he fed all this information into AI and he sent me the report back, and then AI was very critical with regards to my financial advice. And AI talked about diversification and that I was not diversified enough and that I was a hypocrite because I said that I don't like bonds, but two of the portfolios that I referred to had bonds in them of up to 25%. And this just made me realize once again that we've got these tools these days that we can use, but that we as individuals still have to take the responsibility to make sure that we test everything. Because what AI did not take into consideration is AI never asked or never checked what type of products we were talking about, the portfolios that I recommended, especially on his income plans, which portfolios I was recommending to the income plan, to the growth plan, or anything like that. AI just said, hey, listen, this oak is talking a bunch of nonsense because he is a hypocrite, he doesn't like bonds, but the portfolios he has bonds in. And obviously some of the portfolios we use, the portfolio manager makes the choices, and sometimes, especially when it's needed for income funds and stuff like that, portfolio manager is going to have a certain exposure to bonds because they have to build in a bit of protection there. So I found it very interesting to have this chat with this person back and forth, and I found it very interesting to see what AI had to say. And I thought to myself, well, I have to share this with people, and I'm going to share it in more videos, because as much as I recommend to people that they should do self-study, read more, watch YouTube videos, do things to educate themselves and speak to one or more than one financial advisor. And although I tell people to make use of AI, it just once again showed me and proved to me that as much as we have all these tools to our availability these days, it actually sometimes muddies the water and makes it more complicated. And I realize there are advisors out there who are still not experienced enough, doesn't have the type of education that I have, does not have the insights or the understanding of investments that I have. But that's fine. Young advisors must learn. As long as you have somebody that you trust to actually go and find out, or that you trust that will be willing to go that extra mile, and not to just try and bamboozle you with any type of advice. So if you make use of AI, great. I think it's one of the best things that you can make use of. It's a very, very big, it helps me a lot in my business. And I know it helps a lot of people to figure out a lot of different things. But at the end of the day, all I want to say is, don't be fooled and think that AI is going to replace myself or your doctor or your lawyer or any other professional because you don't want to pay them or you think they're too expensive. Okay. Anil says, always follow and listen to you, all your financial plans. Thank you very much, Amil. I appreciate it. Thank you very much for the good comment. Lwaganda, I hope I pronounced that correct. Odd question, would you advise diversifying financial advisors, meaning having more than one? Actually, it's not a bad idea. I must be honest with you, it's not a bad idea. I don't think that very often it's necessary, but I don't think it's a bad idea. And the reason why I say it's not a bad idea to diversify financial advisors, I started off my career with doing estate planning for people, so looking at their life cover, disability cover, and their retirement planning. As life has gone, as I've built my portfolio and my clientele, I have gradually moved over to specializing in investments more. So these days, I am more of an investment specialist. And I also deal, most of the people that I deal with, I help them with the investment planning and the retirement planning. But I still do some risk cover for clients because I still do the estate planning, although there are advisors even in my practice that I sometimes ask to do the quotes for me for different people because they know which company has the better disability cover or the better severe illness, whatever the case might be. So I make use of them to help me with the risk products for my clients while I do the investment products. And then things like medical aids. We don't do medical aids because we're not specialists in it. We've got one medical aid product that we can sell, and we tell people we're not specialists. We rather refer you to somebody that's a specialist. The same as short term. I've got a bit of a short term book that we've built up over the years. And that's basically clients over the years that said, listen, yeah, you've got all of this, do this for me as well. And when you are young and you're still building a practice, you want to do everything because you need every cent to survive, trust me. But yes, if you look at what I've just explained to you, and you have somebody that specializes in your risk planning and can do your estate planning for you properly, if you have somebody that can do your investment planning and retirement planning, can do that properly, if you have somebody that can do your medical aid and your short-term insurance, I think those are the four most important pillars, although there are some other specialized products as well, then you are actually doing yourself a great favor. Whether everybody can actually diversify that much depends on how big your portfolio is, obviously. But I do think what you recommended here, what you asked here, is absolutely 100% good. Thanks for that question. Faisal says, okay, and now we saw my over the time. One moment it's two little questions, next moment it's too many. Faisal, I'll quickly answer yours. There's two or three. Is it okay to have two tax-free savings accounts from two different companies, like Old Mutual and Sanlam? Faisal, it's okay, but it's just a bit dangerous for you as the client. And the reason why it's a bit dangerous for you as a client is if you do not concentrate on ensuring that your contributions to those two companies together does not exceed 46,000, because remember, you are now responsible to check it. Old Mutual can't check on Sanlam and Sanlam can't check on Old Mutual, so they're kind of assuming that whatever you contribute to them, that's what you contribute. So if you want to contribute 46,000 to one of them, the other one's not going to know about it. If they don't know about it, they will also allow you to earn. And if you contribute to both of them and you contribute too much, then remember, you get taxed on every cent over the 46,000 Rand. So it's okay to have two tax-free investments, absolutely. But be careful when you do that you do not shoot yourself in the foot by contributing the rules and the regulation, because then you are going to pay the price for having two different investments. Maonza says you are excellent in clarifying questions asked. Well, oh, thank you very much. Thank you. I appreciate the kind words. I absolutely do. Or is it better to have just one? Faisal, I think it is better to have just one tax-free investment, because at the end of the day, these companies have great portfolios. So as long as you invested in a good investment with a good portfolio, you don't have to diversify. We had this conversation about 10-15 minutes ago about people over diversifying. It's really not necessary. Last question, as always, thank you for the feedback. Truly appreciate. Oh, this was Luagandu, I think it is. Thank you very much, folks. Tonight was a quiet night, if I can call it that. Quiet in the sense that there was never more than about 35-36 people in the call. But to you that were here, I hope and I trust that what I have shared with you tonight was of value. You know, you're welcome to contact me on my WhatsApp number, and I do absolutely reply to everybody. I hope I don't miss anybody, but you're welcome to contact me. For now, I'm signing off. It's time to go and grab some supper and go and have a lie down. You must have a fantastic week and a wonderful weekend. Enjoy all the sport and the weather which is getting better. And hopefully I see all of you again next week, Thursday night, for another Q&A. Keep well, everybody. Bye-bye.